that don't know LPX yet, LPX was founded in 2004, and we started and published the very first private equity index at that time. That was in 2004, which measures the performance of private equity companies. And we launched the very first index at that time. It was called the LPX 50 index. So it includes 50 private equity companies that are listed on the stock exchange. And those indices are used for various purposes. It can be used as an underlying for an exchange traded fund. It can be used for benchmarking purposes, but it can also be used to measure risk and return in of private equity and include that in an asset allocation tool, as you can use in a similar way as that you use other indices from other asset classes. So that's a short summary of what we are doing. When we look at the typical drawbacks of existing benchmarks, I mean, one problem is the so-called self-reporting bias. So in many cases, the data is reported by general partners themselves. So they provide the data on their investments. However, as you know, there is some conflict of interest there. So which data should a manager provide? Who is tracking whether this data is correct or not? And then you typically have a time lag. And there is typically also not an independent auditor. Of course, private equity funds are audited, but it's not the same audit as you know from other markets, from other asset classes. So that are typical drawbacks of private equity benchmarks, private market benchmarks. And I would like to show you how you could use our data to overcome those type of drawbacks. Commonly used benchmarks, as we have seen at the poll a few minutes ago, many still use public market index. Some still use absolute amounts. And of course, private equity composites, so which is data from private equity funds, is also used. However, there are some drawbacks, and the flaws that I just mentioned at the slide before cannot be overcome with any of those currently used benchmarks or valuation tools, let's say it. And the most important conflict is between, you see it here, between whether a benchmark is measurable or whether it's appropriate. So of course, the cash flow data of private equity funds, of closed-end private equity funds, is appropriate. It's reflecting the underlying investments, it's reflecting the underlying economics and how the asset class performs. However, it's not measurable. When you think about how you measure the performance of a stock market investment or the performance of a bond investment, there is no question that this data is updated on a daily basis, sometimes on a real-time basis every second. Whereas in private equity, it's still common that you have an update maybe once per quarter for the large funds, for the smaller and not so known funds, sometimes only once per year. So there is this conflict of interest, conflict of objectives between whether it's measurable or whether it's appropriate. And as you know, a public market index is measurable, it's transparent, it's specified in advance and so on, but it's not appropriate. A small cap index might be some way correlated to private markets, but it's certainly not an appropriate index to use it. An absolute amount is also very, very easy to use in an asset allocation or performance tool. However, it's not, in our opinion, not appropriate. So how do we solve this issue? So we are, with our data set, able to have, on the one hand side, an appropriate index, appropriate data, and on the other side, data that is measurable and updated on a frequent basis. Our data is based on companies that are regulated, that use generally accepted reporting standards, and the data is updated on a regular basis and frequent basis, and it comes from independent and public sources. So the question is, how do we do that? It's a very, when you see it, it's a very simple trick. We focus on private equity companies that are listed on the stock exchange. Typically, when you think about a private equity fund, about the wrapper of this portfolio, this is typically a limited partnership structure, a closed-end fund, and this is typically not listed on the stock exchange for obvious reasons. However, there are around 100 companies on a global scale of private equity companies that are listed on the stock exchange, and where you can then get access to the composition, to the investment portfolio of those companies. And because they are listed on the stock exchange, you know where they invest in, you know the valuation, you know latest investments, latest exits, and you have very high reporting standards because they're listed on the stock exchange. They have to fulfill the criteria and the listing rules from regulated markets. So this sounds simple. However, you have to go through those portfolio companies to the reports, read the reports, read not only the annual reports, but also updates between the reporting dates, to incorporate this in the database and to make it transparent and standardize the data so that people are able, or investors are able, to use the data to benchmark either single portfolio companies or on aggregate level and portfolio. So that's how we approach, how we get our data. To give you an easy example, one investment is Visma. It's investment by HG Capital Trust. They invested in 2008, and here you see the NAV, and the NAV in this case reflects nothing else than the valuation of that single investment. And when you have then the whole portfolio of, in this case, HG Capital, then you have the NAV and the valuation of that private equity portfolio, which is traded on the stock exchange. And we use that type of data to construct an index. So you see here, the gray line are the official NAVs as published by the company. So you have already a quarterly update in most cases. However, between those official reporting dates, you can have some news. Typically, because the companies are listed on the stock exchange, they have to announce a new investment, they have to announce a trade sale, an IPO of one of their portfolio companies. They update revaluations in case a new investor comes in, and so on. So between those official reporting dates, we use that data to update our own valuation tools and data set to come up with a more updated and have made, let's say, an early indication of the development of private equity in general. So that's, in a nutshell, how we construct, how we collect and then transform the data into an index. However, there's also data on a single company level available. Then when we construct indices, benchmarking data, we have several indices. We have global indices, we have a style index measuring buyout and venture. I will show you the characteristics of buyout and venture in a minute, and then also focusing on different subsegments of that asset class. And because we have that data in a standardized way, we are also able to customize indices to reflect individual portfolio characteristics. That's the very nice thing when you have regulated and standardized data in this asset class. You are able really to customize not only regarding buyout and venture, also regarding regions, in order to reflect individual characteristics of an investor's portfolio. Then a question that often arises, is this really reflecting? So it has to be appropriate, which I mentioned before, it's a very important point. So because we know where the companies invest, we also know what was the investment style. Was it a buyout deal? Was it a venture deal? Was it a growth deal? And we also know in which sectors they invested in. So we have a sector allocation regarding the GICS codes. You see it here. So we think that this is reflecting the underlying investment characteristics quite well. However, if you're interested, I'm happy to give you more detailed information on that in a personal meeting or conversation. Also regarding vintage years, also this we are of course able to track because we know when the investments were done, were made. So we have also the vintage year allocation of a portfolio, and this can also be sliced down to individual portfolios. In the next 3 to 4 slides, I would like to show you some performance characteristics. So this is now measuring the underlying performance, the net asset value of private equity portfolios, of private equity portfolios that are listed on the stock exchange. But important to mention, it's not the stock price that we are tracking here, it's the underlying performance of the net asset value, of the valuation of those companies. Here, over the past 10 years, we have here an annualized return of 9.5%. Over the last 3 years, it was around 11% per year, so that are annualized figures. And I have now compared this to a small cap index, because as I know that many investors, many limited partnerships are using a small cap index to measure the performance. As you can see here, performance-wise, it's different. Well, when you look at the chart, maybe it doesn't look that different, but when you look at the numbers, it is different. 10 years, it's only 7.6%. Over the past 10 years, it's 10%. Over the past 2 years, it's minus 4.5% on an annualized basis. So there's a huge difference. And the most important difference is when you compare the volatility, so the risk. Our NAV data has a volatility of around 5%. When you take a small cap index, the volatility is around 16% on an annualized basis again. So here you already see, well, this is much more volatile than what I would expect from a private equity portfolio. Then you see also the correlation number, it's only 0.26, which means private equity is correlated with a small cap index of only 0.26. So there's basically no correlation between those two asset classes. That's why we say a market index, a small cap index, it's easy to use, but it's definitely not appropriate to measure the risk and performance characteristics of private equity. And now when you compare buyout and venture, as you know, it's important to differentiate between those two subsegments. You see here again the development of the NAV index of buyout and venture. On the right hand side, the blue line is the venture index, and the turquoise line is the buyout index. And also here you see, well, there are some phases, some time spans where it's very similar development. However, especially in the last 12 to 18 months, there is a significant difference between buyout and venture. Buyout returned around 15% over the last 15 months, whereas venture returned minus 15% over the same time period. The economic reasons for that, I think, is clear. With the rising interest rate environments, venture capital investments, startup investments have to be written down, because the discounted cash flows takes into account higher interest rates. So it shouldn't be a surprise. However, in the buyout market, the rising interest rate environment doesn't have that impact, because in the buyout market, we talk about EBITDA multiples, about sales multiples, and so on. So which is much more healthy as compared to the valuation of a venture capital investment. So, but again, here you see also difference between risk volatility. It's around 6% for buyout, and it's around 8.5% for venture capital. Also, that's something you would expect from that asset class. From venture, venture is slightly more risky compared to buyout, and this is also reflected in our database. So then, in addition to that, we are also able, of course, to have quarterly returns using our data. This is now going back to 2003, so our data goes back, almost, no, in the meantime, more than 20 years. So we have more than 20 years data here in our database. And this can be used as a daily time series, as a monthly, or as a quarterly time series. So this is in a nutshell how we construct the indices, what the results are of the indices. And just to summarize, I mean, one of the main advantages here is that we have a daily availability of the data. So you can use our data set in a similar way like you use time series data for equity investments, for stock market investments, or time series data for bond investment, and so on. So we can use the same tools and just input our database for benchmarking purposes on an aggregate index level. Then we have transparent data, and we have also data on the underlying investment company level. And because the companies are listed on stock exchange, it's much more reliable what they publish, because they have to fill some listing rules. They have to have an independent auditor. Self-reporting bias is almost impossible here, because then they would breach some listing rules in case they just report any misleading figures. And last but not least, our data is easily available. You can download it from Bloomberg, you can download it from Refinitiv or from other data vendors. Of course, you can also access it directly through our website, but it's much more easily available and can be handled in a much more easily way compared to other data sources.